with our next session here on Note Camp and our next expert. This guy out here, if you're in the originating space, you're looking to originate some notes, one of the most required things you gotta have these days, if you're going to be doing it more than once or more than every once in a while, is you really need to have a Dodd-Frank compliant loan. You need to have an RMLO, somebody that's going to help you walk you through the process of making sure that your loan is Dodd-Frank compliant. It also makes it a truly saleable loan in a lot of cases. And so after last year's Note Camp, one of the biggest questions we had and people requested, hey, let's talk, can you get somebody on to talk more about creating Dodd-Frank compliant loans or making sure everything works well? And so one of the first person when we settled on a date here is I reached out to Max Bailey here at Call the Underwriter. And Max is very well known in the industry. Call the Underwriter is the only company I refer people to when it comes to, hey, I need help originating out, who do I need to talk to? So you just got to remember to call Max. Call the Underwriter. And so call Max Bailey. So Max, we're honored to have you join us from, you're in Montana, I remember if it correctly. Is that correct?
Correct. Yep. And
you may have heard us talking beforehand. He's in the process of building his dream home and everything like that with him and his wife out there. And so we're glad to have you here on Note Camp for the first time. So Max, you want to talk a little bit before we dive into kind of the nuts and bolts of Dodd-Frank and owner finance, and how you got into what you're doing now, maybe your background in history?
Sure. Yeah. Kind of fell into it like I have everything in life. But, I always say I didn't put much planning into getting born. And that's kind of how everything else has happened in my life as well. I'm just kind of along for the ride. So, I was a firefighter for 30 years and had a lot of time off. And so every firefighter does at least one or two other gigs on the side. And so I started buying rental properties about 25 years ago. And that led me to doing a lot of property financing and a lot of management, even ended up writing a book on rental properties and all things rental property. Well, along the way, because I don't sit well, I got bored. So I went and got 3 college degrees. Don't ask me why. But one of them ended up being in finance. And over the years, that just kind of was something I was interested in, I guess. And so when I wasn't being puked on professionally, then, I was crunching numbers and doing rental properties and buying and selling. And then when I got ready to retire, I decided I'd better do something other than run in or out of burning buildings. I'm definitely getting too old for that. And so I ended up partnering up with Russ and learning this business. And then I ended up buying him out and taking it over. So sent him on a vacation and I continued on.
That's good stuff. Now let's talk about kind of what your specialty is. Let's talk about Call the Underwriter. What are you doing with your clients you're working with, and when do folks need to call you when they don't?
Yeah, great question. Okay. So for anybody that doesn't know anything at all about let's say creating a note, right? The federal government has a lot to say about how you create a note and how you loan money. This is particularly important with respect to owner occupied. So when we talk about regulation over note creators, we're primarily talking about Dodd-Frank, which is relevant to owner occupied dwellings of 1 to 4 units. So anybody looking to buy and live in a 4-plex or smaller that's going to borrow money, whoever they borrow money from, that lender is subject to the regulation of Dodd-Frank, the 8 elements of ability to repay. We talk about ATR a lot. So ATR is ability to repay. That's what sort of runs our life. And then the CFPB, the Consumer Financial Protection Bureau, they are the teeth of Dodd-Frank. And so we talk about them both sort of interchangeably, but for the purposes of understanding the entities, the CFPB would be the enforcement arm of Dodd-Frank. And so just a little bit of quick history. Dodd-Frank was born in 2010. almost directly on the heels of the housing bubble burst of 07, 08, right? And so what I tell people all the time when I'm kind of coaching them through how to set up their note origination business and appreciate Dodd-Frank, it's in the context of understanding what led to it, right? What makes it relevant is the history that led to it. And so Congress was given the mandate after the housing bubble burst of dig into the banking industry, particularly home loans, and find out what went wrong. And let's ensure that we create rules and regulations to end the wild, wild west and predatory lending and teaser rates and all the risky features that led themselves to the housing bubble burst of 07 and 08. And so with that as a background, then people can sort of appreciate as a note originator why we talk about Dodd-Frank constantly and how they have such bearing over what we do. And so this piece of legislation called Ability to Repay is several hundred pages long, and it's in a portion of Dodd-Frank that speaks to all lenders. They break them down in categories. There's Fannie and Freddie lenders, there's large cap lenders, there's small cap lenders, but even seller finance is pointed at in Dodd-Frank. And like all good legislation, it's incredibly ambiguous, contradictory, and vague. And so it meets perfect criteria to be something that we're all underneath as having been mandated by Congress. And so our business's sole focus is to understand the 8 elements of Dodd-Frank, ability to repay, and help guide all of the seller finance community in ensuring that the terms of their deals are compliant, and then that the borrowers that they select and loan money to are compliant.
And compliant, it's like you said, there's a variety of different features in there depending on how big the lender is, how strict you have to be in a lot of things. But there were some major changes, as we're kind of talking about owner financing, on the amount of people that could originate without having to jump in and worry about being Dodd-Frank compliant, wasn't there? Is there like a number or specific things?
Well, no, that's sort of a misnomer.
Okay,
anybody that loans any money to anyone for an owner-occupied house must meet the 8 elements of ATR. They must ensure their borrower meets ability to repay. But if they're not a licensed RMLO, they can do up to 3 of those transactions in a 12-month period without being required to get state NMLS, RMLO licensure. And so that's where the confusion comes in. And I've heard a lot of people say, well, since I'm only doing so many of these a year, I don't have to worry about Dodd-Frank. Nope, not true. And here's why you can know that that's not true. The spirit of Dodd-Frank is making sure that there aren't predatory lenders out there that are contributing to a high default rate, right? And so they care about even one borrower. If you're selling a trailer house to even one family buying that trailer house, you are still subject to ATR and the elements of Dodd-Frank. The only exception to that is a one-off transaction where you had, let's say maybe you inherited a house from mom and dad. You're not incorporated. You're not a note originator. You're not a lender. Just to keep it real simple, we'll say you just inherited a house in another state from a relative, and all you're asked to do is liquidate the estate. You're going to try to sell that thing on owner financing one time just to be done with it. That would be the only way that a person could probably feel safe in doing seller finance on an owner occupied transaction and not potentially being scrutinized on, did they vet the borrower for ability to repay?
Well, that makes good sense. I'm glad you cleared that up for a lot of folks out there, because there is a lot of that. You hear people say different things with a lot of different situations. 3 and 12-month period. Oh, I don't need it. It's better too, because actually that paper is more valuable. It's actually making sure you're not going to stub your toe later on, right?
Yeah, it is. And if and when a borrower defaults and goes and gets a smart attorney, and they're everywhere.
That's debatable.
Oh,
wait a second.
yeah.
That's debatable.
This poor victim, the first thing that's going to happen is CFPBs are going to get drug into it. And the first thing they're going to do is dig deep and review that entire transaction from top to bottom. And so it won't matter that the borrower, theoretically was making the payments for the first 6 months and then went out and got stupid and overspent his money in another area, and now he can't make the mortgage. None of that will matter. All that will matter is when they vet to see were the components of this transaction compliant and legal, and was the borrower legal with respect to ability to repay. No other excuse is going to hold any water. And so one of the things that we do is produce a file which the government says that you have to retain for 3 years at the end of every transaction. And then the CD, the closing disclosure, you actually have to retain for 5 years. We produce all of that for you, and we build you a file that will demonstrate transparently your regard for ATR and Dodd-Frank, and will be your defense file on showing how you vetted your borrower. And so throughout Dodd-Frank, the authors use 2 or 3 consistent pieces of verbiage, basically. They talk constantly about talking to the lender, so talking to all of you loan originators, that the onus is on you. And so the language is put all throughout Dodd-Frank that says you must employ underwriting practices that result in historically low default rates. And that's peppered throughout the hundreds of pages. Your underwriting practices must be proven to result in historically low default rates using reasonably reliable third-party records, and you must make your conclusions and your decisions in a good faith effort to look out for your borrower's best interest. And so when you boil those 3 themes all down together, you're really looking at any transaction you do, you have the ability to be called on the carpet for that. And they won't have to prove that you didn't do it right. You'll have to prove that you did do it right. And the burden of proof will be on you as the loan originator. And so that's kind of where we step in, is that we help build these files all day, every day, 7 days a week. And so we have a very consistent, methodical approach using the same underwriting principles and practices employed by Fannie and Freddie and FHA and VA. And so when we get to the end of an underwriting file and we produce a certificate of ability to repay, and we provide you with an ATR certificate on your transaction, that'll come with a ream of other due diligence that we have produced that demonstrates your methodical research in the 8 elements of ATR.
Well, let's dive into that, because you say something. You're basically guilty until you prove otherwise with this. If you screw up, you're guilty, no matter if the borrower has to stop paying, no matter what they signed on.
Yep.
You're guilty until you've proven yourself innocent, and that's unfortunately. But that is kind of what happens. Is people will file a complaint with CFPB, and CFPB will open a file on you.
Absolutely.
And usually the starting penalty is $50,000 for a CFPB company. So this is important for you guys out there to know this. We've had a few CFP, because in the non-performing section, people file CFPB late, you get a notice from CFPB that you get a complaint filed against you. Usually I provide some documentation. We were able to prove that we didn't originate the note, first and foremost. But before you bring in the 8 points, isn't there a date of loans originated after a specific time frame that have to fall on that? What's that date?
Well,
like
2010 is when
Right.
Dodd-Frank was actually signed into law. And
Yep.
then there was an update in 2014, and they continue, as Congress is faithful to do, to convolute and contradict and add and take away from every law every single year.
Yeah.
And so one of the big things I have to do routinely, and I do as a mortgage loan officer anyway, but is constantly be reading everything that comes out with respect to all of the lending laws to ensure that we're still getting, helping you disclose according to the law and the timelines. Are all of our disclosures current and up to date? Right now they say you have to add this to this disclosure, and you have to have this signature on this disclosure, and this set of disclosures used to be 10 pages. Now it's 12 pages because they want you to put in this and this. We keep all that current throughout the year and stay read up on that stuff because it's changing constantly.
Yeah, exactly. I mean, even like the points on a statement, or it had to have like 40 points on a mortgage statement that you mail out. If you were a servicing company or a mortgage company that had more than 4,000 loans, you had to have it all compliant. That's just a pain in the ass in a lot of cases. But
yeah,
we keep referring to, somebody asked me, what are the 8 points of the ability to repay? Can we kind of cover those 8 points for everybody?
Yeah. Okay. Yeah. And the 8 points, I actually perform multiple steps that are somewhat different from these, but in general, I'll just rattle them off to you, and then I'll kind of talk about how we do it.
That's perfect.
And so when we talk about the 8 points, we're talking about verifying your work history, your income history, your debt to income ratio, a state specific residual income, 24-month positive credit history, history of any delinquencies, defaults, encumbrances, any court orders. What else is there? And then just what all of your other debt would be on your credit report. And so the law says that we have to dig into these 8 areas, and we have to do due diligence to ensure that these borrowers. So in other words, it's not as simple as just saying, well, the borrower, can show proof of funds that he's got 50,000 in the bank, so he could easily make this $1,100 a month mortgage payment. Nope, that doesn't fly. That doesn't fly at all. For one thing, he could have judgments against him that are going to come clean that out and take it all away tomorrow. And your responsibility as a lender to ensure that you dug into that and that you can, with reasonable certainty, using reasonably reliable third-party records, sign off on that saying he didn't have any judgments, liens, or outstanding court orders against him. And so that's what we do, is we look into all those things. We have 10 questions we recommend. So a lot of people would say, well, how do I begin all this? Okay, so I've got a house. Let's say I went and got a house and got it bought, and now I want to turn around and resell it at 10% on a 30-year loan. How do I get started? The easiest thing to do is look at our 10 questions to ask every borrower, and that's on our website. And I highly recommend you always incorporate a little bit of pre-screening into vetting your borrowers, because probably 90 to 95% of the time, if you just incorporate those questions into your pre-screening, then you won't take earnest money deposit, and you won't sign a purchase agreement with anybody that's automatically going to be a red flag that we'll have to throw out. And there's a lot of them that you'd think would just be no-brainers, but they're really not if you don't know to ask them. Social Security number or an ITIN. All borrowers must have one or the other. And so we get a ton that come to us, And not until we're looking through everything that we notify the lender, hey, loan application's missing social security numbers. Can you get those? Then 2 days into it, it comes back, oh, turns out they don't have any socials and they don't have any ITINs either, but they plan to apply for them. Well, that's now a dead deal. Not that nothing can be done about that. There's no way in God's green earth to make them compliant. And you know, that cost them time, energy, and money that could have easily been caught if they'd have just known to ask that question. And so anyway, you want to begin with the 10 questions to ask all of your borrowers and make sure they pass those with flying colors. We have a few investors that have actually created their own little gouge using them. And so when they send us a loan application, they've already incorporated all those answered questions in there, sort of as a proof of saying, we know for sure that unless they're lying, you know, they've already affirmatively answered all of these. Then, with the assumption that all of what your borrower told you on those 10 is good to go, most of the time, your borrower is going to meet requirements. The only reason they wouldn't then is just that the terms of the deal are more than this borrower can support. And I've even got a lot of handy, quick formulas that I coach people to do just on the fly that will give them a really good indication ahead of time how much their borrower can support. You know, so just some quick rule of thumbs. A borrower needs to stay under 57% debt to income ratio. And so if you take their GMI, their gross monthly income, and multiply it by 0.57, that would give you the total amount of debt this borrower can carry. And then if you subtract the PITI of your deal, then that number that remains, that's what has to cover all other debt this borrower is going to have. So when you sit down and have that conversation, you might even put out a flyer, right, saying, to qualify for this home we're selling, the PITI is going to be X amount. You'll have to have X amount of income after all of your other debt in order to be eligible for this house. If you meet those requirements, give us a call. You know, a lot of different ways that you can approach that thing that do a lot of your work for you, so that you're not dealing with 100 looky-loos. You're maybe only dealing with 8 or 10 people that legitimately already fit that parameter. And so we kind of help people figure all that stuff out.
Now, are you using like a Calyx report or like a 1003 application? Those are kind of the normal forms used as a loan officer and mortgage brokers there.
Yeah. So on our website, there's a borrower's application guide. That borrower's application guide, that right there, that guide has a link in it, and that goes to an automated application. So you'd direct your borrower there, or you'd hand your borrower that piece of paper with that link in it, and they click on it. They fill out this loan application. It comes straight to us. And then we just marry it up with the documents we get from you. So kind of the way a transaction begins is the loan originator would send us a term sheet. That term sheet has all the terms to the deal and all the information from the lender side that we need. And then once we get that, we just wait to see the applications and income come in, and then we sort of marry it all together into one file. Then the first thing we do is we look it over and we put out a needs list to the investor and to the borrowers, stating everything else we need. And then as quickly as that all comes in, we get to work on the file.
Now, when you're, you mentioned something that need to be below 50%, 57% total DTI. Now, when you talk about the terms of the deal, you talk about, okay, hey, we're willing to underfinance this house. We're going to sell it at 100. 10 grand down payment, 90% LTV first, or an 80% LT first and a 10% second at these interest rates. Is that what you're kind of talking about as far as the terms of the deal?
Yeah, exactly. So let's say they you know, in lending, everything's about loan amount, right? Because that's the PITI is how we calculate a debt to income ratio. So not to talk down to anybody, but just to kind of break it down in its most easily understood method. Yeah, so you're going to structure your deal. Let's say you decide you need 250,000 and you want 10% at 240 months. Maybe you want a 20-year note. And then you come up with a PIT on that, right? Probably you'll just come up with a P&I, just the principal and interest payment. That's what you'll put on the term sheet to us. Yep. And ideally, you know what the annual tax is as well. And maybe if you already own it, you maybe have an idea of what your annual insurance is. So those four figures compose that PITI. The other issue would be if it's in a flood zone, it's going to have flood insurance, which is another figure that has to go into that, as well as homeowners association or any of those kinds of additional things that the borrower will be on the hook to pay for every month, association dues, condo, any of that. So, but basically, yeah, you're taking that principal, interest, tax, and insurance figure plus HOA, and you're coming up with what a monthly all-in payment is going to look like. And then, of course, that differs greatly based on things like the size of the loan amount, how much they put down, and the term. If you only want a 180-month term, then it's going to be a far bigger PITI every month than if you want a 360 term. Another thing that we end up doing a lot when those terms are sent in, we crunch all the numbers. We don't just say your borrower doesn't meet qualifications and close the door. We rack our brains and come up with every possible tactic we can to get your borrower approved. So usually what I come back with when a borrower is over DTI or under residual income is I come back with a range of options. And that might look like getting a hold of you and saying, hey, listen, Bill, this borrower meets general requirements. So they've got a 2-year work history, they've got a good income history, and they can document it. They have the potential of fitting this deal, but they're currently $400 a month over debt to income ratio. So maybe I find one payment on their credit report that they could go pay off that would bring them down. Or maybe I notice they're on the terms, you've got a 180-month term, and I say, at a 15-year term, that spikes that P&I too high. But if you're willing to drop it to a 20-year term or a 30-year term, I calculated it, and that would just get you under, and he'd make it with this. Or, maybe we look at the APR and say, hey, listen, you're at 10.5. If you tweak the term just a little bit and you drop the term, the APR to 10, your borrower's going to squeak under. So we do a really thorough job in doing everything possible to make this thing fly. It's last case scenario for us to break a deal.
I like to say it's massaging the numbers to make it fit.
It really is, and being extremely creative to help the investor see what he doesn't see to save the deal, right? Our job really is to try to create a win-win, keep the borrower in and keep the lender seller in at the same time.
Yeah, and I think it's an important thing to realize. That's good, because a lot of times most folks, it's black and white, yes or no.
Yep.
There is a lot of gray, and it's like you said, you can massage those terms to get things to work a little bit different. You're dropping the interest rate a little bit to hit that APR down, or to reduce the payment a little bit, or like you said, just hey, you've got these low balance credit cards that are $400, go pay them off. So drop your DTI to a point that makes sense. Now, I want to ask you a question, and when you look at and you're supposed to be able to identify if this borrower can pay for 3 years from now, basically.
Correct.
Is it reserves in the bank? Is it money that they're making? Their DTI is lower. What happens when COVID kicks in and people get laid off? That makes almost question. You know what I mean?
Great question. So we'll talk about that. Yeah. What is what is a onus on you and what is an acceptable reason for default. And we'll talk about how that ties into 3-year continuance. So for anybody that doesn't know, what Scott's referring to with 3-year continuance is when you vet a borrower for ability to repay, it's always looking forward. We look backward 2 years and we look forward 3 years. So when we talk about your ability to repay into the future, we're always looking at 3 years. A good example would be, let's say your borrower says, hey, I get $600 a month child support, and so that's going to help carry this thing. And so we crunch all the numbers and we realize, yeah, they won't qualify without the child support. No problem. But you need to know up front to be able to ask the question, will that have a 3-year continuance in it? In other words, if your youngest child is 17 and you're counting on $600 a month in child support, that's not legal because that does not have an expectation of 3-year continuance. Whereas if somebody says, hey, listen, I get a VA disability and I'm 55 years old, here's my award letter and here's my 1099 from last year. You don't have to vet 3-year continuance on that. That's expected to continue into the future. Or a Teamster's pension or Social Security benefits, those things. And so, yeah, 3-year continuance is very important. And for that reason, we typically give very little credit for reserves in the bank because they can always be spoken for.
Yeah.
Now, I might write in the underwriting notes to strengthen the file and to make you look better as a lender and to make your resale of this note look stronger. I may put a lot of compensating factors into the underwriting notes at the end that says, some strong compensating factors are, this borrower's got a LTV under 75, 22-year work longevity history, 60,000 reserves on file in the bank, and low credit utilization. Those are all positives for sure, but in and of themselves, they don't carry the day if there's a red flag. And so now to address your other issue of what happens when we vet our borrower and everything's good to go, and then 6 months from now, the economy takes a turn and he gets laid off. Think of underwriting as a timestamp. So my name is on it, your name is on it, and the borrower's name is on this timestamp. So it really doesn't matter what happens next week, as long as this timestamp shows that at the time we did the homework for you, there was no reasonable expectation that this borrower was going to be financially dependent next year. And that's one of the reasons why seasonal employment can be difficult.
Right.
And commissioned employment can be difficult, as can self-employment with declining annual earnings. And not to get too deep and far into the woods, but just to say that any of you that start using us, I can coach you a lot on how to vet income and how to ask the right questions. And I will myself as well, to really help you understand when you don't have a traditional, the ideal borrower is, a guy that's retired with 3 pensions and could commit a felony and those pensions can't be taken away. And they've got a 6% annualized cost of living adjustment for CPI. And in 5 more years, he gets a Social Security kick in. And essentially nothing can happen to this guy that's going to reduce his income. It can only go up from here. But those of us in that situation are fairly rare. Self-employed borrowers are very sketchy. And then seasonal part-time workers are even worse. And we get a lot of them in this demographic.
Yeah.
And so I guess the easiest thing I can say is that, if you start working with us, I'll teach you a lot of that, and I'll help you understand what to look for and what to run from. But yeah, 2-year work history, 2-year income history is a huge issue. Another huge issue that should really be talked about, and I've got a document on our website that you can go find and it's called Understanding Loan Conditions. So it's important to understand that there's multiple aspects to loan approval, more so than just this guy's income meets the requirement for, let's say, how big the PITI is going to be. And loan conditions can relate to things like credit worthiness. The law says that we have to establish 24 months of positive credit worthiness. So what does positive credit worthiness look like? Well, Fannie and Freddie go real simple, and they just draw a black line in the sand that says positive credit history looks like at least 2 lines open for 6 months minimum, and no current collections, no delinquencies in the last year, and a credit score over 580. And that's their definition. And if you don't meet that, they close the door in your face. Well, understanding loan conditions helps you as the lender pre-anticipate what kinds of hoops your particular borrower will likely have to jump through. And what's important about that is I can teach you how to weave that into your interview and your pre-screening, so that you don't wait until it gets to me to find out that your borrower is going to have to, provide 2 12-month payment histories from the alternative credit list. And oh, by the way, he doesn't have any credit. His car payment is in his niece's name, his cell phone's in his uncle's name, and he pays his rent with cash under his mattress. That guy's an ineligible borrower, and it doesn't matter if he makes $1 million a month, you can't loan to him. And so I can help you understand that ahead of time. And that document called Understanding Loan Conditions walks you through many of the scenarios that befall people in this demographic that will likely raise a flag that we'll have to get around. It doesn't mean it's a deal breaker, but they're time-consuming events, and you want to vet them ahead of time. I'll just give you a really easy one, a really good example. Anybody with a credit score of less than 620 is going to be required to provide a VOR. That's a 12-month verification of rent, proving that they've made their last 12 rent payments on time with no lates. The reason for that is the federal government says you have no business getting a home loan if you can't even pay your rent on time. And if you have a credit score under 620, there's significant suspicion, right, as to whether or not you consistently can make your payments. So when you're having that talk with your borrowers, you want to be able to go there and say, what are we going to find when we pull your credit? And you might as well be honest, because we're going to pull your credit. Do you know your credit score? It's not critical that they know it, but the way they respond to that is critical. When you get that person that says, it ain't going to be good, then you want to dig deeper and say, is it likely under 620? And if it's bad, are you prepared to provide a 12-month verification of rent from your current landlord, stating how long you've rented, how much you pay, and them stating that you haven't made a late payment in the last 12 months? You might as well do that all up front with them, because I can't tell you how many deals get broke by we get the whole underwrite done and we send out conditional loan approval saying, provided the borrower can do this, this, and this, they will meet ability to repay. Everybody gets all excited and jumps up and down. And then a week later, they get back to us and say, we can't produce that VOR. And now it's a broken deal. And the lender could have, anticipated conditions like that before ever signing a purchase agreement. And that would be my advice.
Yeah, that definitely, let's nip that in the butt in the front end versus doing all this work in
yes,
grief.
Another really good example would be on our website, you'll see a document called the Alternative Credit History. So for anybody that doesn't understand 2-year history of credit worthiness, the law says that credit worthiness is defined as 24 months of immediate past credit worthy history. Well, many people in this demographic are in seller finance because they have no credit. I mean, literally, when we punch their social security or their ITIN into our credit database, you get back no record found. Literally, they're off the grid. They're off the radar. And that's okay. And that's why they're in seller finance. Fannie and Freddie shuts the door in their face. All traditional lenders do. We don't. The law doesn't say they have to have a credit report. The law just says that we as lenders have to ensure that they have a positive 24-month credit history. So we've devised a very complex alternative credit list. I highly recommend you incorporate it into your borrower screening practices. And while I was sitting there with my borrowers saying, tell me about your credit and your credit history, I'm specifically trying to find out, do they currently have any open lines of traditional credit?
Right.
And so I'm going one of two ways in the algorithm with my borrower, right? One is definitely credit score above 620. They're confident. Absolutely, it rocks. I know it does. I'm good to go. The other one is not sure what you're going to find. VOR. Hit them on a VOR and see if they can produce it. Don't move any further until they either can or can't. Same thing. Do you have any open credit lines? Do you currently have car payments that are reporting to credit? Do you currently have any revolving credit lines? Do you have student loan debts? Do you have anything that every month you're reporting to the credit bureau? When you pull your credit, what do you find? You're looking for the either I've got some or I have none. Which way you go on the algorithm tree totally depends on the answer you get.
Right.
If they've got some, then no big deal. Probably just need to say, do you have any current delinquencies? Do you have any open collections? Might as well tell us again, because we're going to find them. And will you be prepared to address them if we do? But when you get that guy that says, no, we don't have any credit at all. We do everything in cash. We work under the table and we don't have a single loan. There's nothing on the credit report. And that's where you have to be able to slap out that alternative credit list that I recommend you have in your packet. And that's got things like car insurance, utilities, cell phone, Netflix, Hulu. Oh man, there's a million of them on there. And then that's when you want to be saying to them, could you bring us proof of at least 2 of these types of vendors that you'll have a 12-month proof of payment history on? Do you pay your own utilities? Can you go down there and get a proof that you've paid your own power bill for the last 24 months straight? Do you make your car payment or your car insurance payment? Will your car insurance company, State Farm, write you a quick letter stating you've been a customer for 5 years and you've always paid your premiums on time? When you get that borrower that says, well, my car insurance is in my nephew's name and my cell phone's in my cousin's name, run from them, because they'll never meet requirements. I don't care if they have 100,000 in the bank, they'll never be legal to loan money to. And so if you incorporate understanding loan conditions into your buyer pre-qualification or pre-screening process, and I know that sounds complex, but if we have a discussion on the phone, I can coach you quickly and make it very simple. But you'll be surprised how much smarter you work and how much better the quality of the borrower you select will be if you use those things and pre-anticipate. I've got some investors, I always laugh because, on this end, I work with investors in all 50 states, thousands of them. And so it's a little bit like being a teacher and grading, kids bringing home their homework. And I don't say this to be judgmental. I'm the dumbest guy in the room. So I certainly don't condescend when I say this, other than just to share what we see on our end. And so I've got some investors that it's like right away, it's like a chess game. They picked it up and you can tell when they send a packet, they've already got a VOR in it. They've already got 2 12-month payment histories in there. They've got all this stuff that they've already pre-anticipated. And we look at it and just go, holy criminy, this guy is playing heads up, man. Wow, he already took care of all this stuff. And then I got other ones that I get 2 and 3 files a month from them. And I hope they're not listening, because I won't mention any names, but every single time they act surprised when we say, well, we pulled John's credit and John has 0 credit. we're going to have to go back to him with the alternative credit list and see if John has anything in his name in this universe that he can pay for that proves that he pays his bills. And oh, what a surprise. He doesn't have a single thing. Darn it. And they act so surprised every single time, you know, and it's like, man, you guys are killing yourself. You're taking earnest money from these people. You're taking the house off the market. You're signing a purchase agreement and you're fronting money to us to vet a file, and you didn't do any pre-screening whatsoever. That's just not working smart. I mean, no problem here. It's quick and easy for me. I'll do it, no problem. But I hate to be the bearer of bad news. I hate to be the guy that has to every single time say, yeah, you got another one here that no chance of flying. And you could have asked 2 or 3 really simple questions and you'd have known to pass this guy on and move on to a different one.
Now, what's the cost for that? You brought that up. There's a fee cost to do this. What's the cost for your services, Max? They let you get a drink of water. I love it, man. I'm getting an education here, man. You know, owner financing has changed so much since when I started doing it back in 2007, 2006. It's a total different. I mean, it was a Wild West back then in a lot of cases, and it's definitely a lot more stuff. But so yeah, what's the cost? What's your services run?
Yeah. Okay. Great question. Bear in mind now, with full disclaimer, I'm tied to Biden's economy like everybody else. And so most likely inflation is knocking on my door pretty hard. We're going to raise rates. But as of today, the underwrite is $559 for a full underwrite. We invoice that in 2 pieces. We invoice the investor $119 up front in the form of a processing fee. That pays us to basically drop what we're doing and pull credit, hand jam 10 pages of data into a database, work up a profile, calculate DTI, state-specific residual income, get all this borrower's income and paperwork sent to us, and do the analysis. Then, after we do all of that, if we can approve the borrower, then we invoice the investor the final $440 for a total of $559. So I'll try to answer a few questions that everybody's thinking already. Number one is it's illegal for the borrower to be charged this fee. So the RESPA and TILA and ECOA, if anybody knows, I know that probably sounds like I'm speaking Yiddish. In lending law, Equal Credit Opportunity Act, Truth in Lending Act, and the Real Estate Settlement Procedures Act. So RESPA, TILA, and ECOA have a lot to say with how we can charge borrowers. That's another aspect of my business, is helping you not violate the law. So the law says that you can't charge your borrower 1 penny for anything except the credit report before offering them a loan. And since we provide the credit report, you can't even charge them for that. So the simplest way to understand this is that we're going to charge you $119 processing fee to get this started. We're going to teach you to pre-screen so that you don't, have that $119 go down the drain repeatedly. And then you're going to take a healthy earnest money deposit from your borrower that makes sure they don't flake out midway through the process. I recommend you take $1,000 earnest money from the borrower. Anybody that can't come up with that's probably not going to meet requirements anyway.
Right.
And then what you do is you'll front our fees to us, and then on the buyer's column on the loan estimate and the closing disclosure, so on the LE and the CD and on the settlement statement, one of the costs of loan origination for your borrower is going to be that $559 underwrite fee. So you'll essentially reimburse yourself for it at closing. Another thing that we can do is talk about points and fees. I can help you recoup costs by suggesting reasonable points and fees that you're legally able to charge your borrower for loan origination. That will also help you bring back some of those costs.
What are you seeing as far as origination points on average? I mean, I know it'll vary a little bit depending on how much is.
Let me tell you what. Yeah, great. Let me tell you what you can't do, which is probably an easier way to tell you what you can do.
There you go.
The law says that you can't charge in excess of 3 points So that's 3% of the loan, period. Loan origination cannot total more than 3%. So on a $100,000 loan, your total points and fees, that is things that are viewed by the law as profit in your pocket, can't come to more than $3,000 or 3%. With that said, it just doesn't always make good sense to charge an arbitrary amount anyway, because if you're wanting to close deals and you're wanting to select the best borrower, a lot of times it's about working with me and us talking about what the borrower can afford, and then just helping you do a reasonable, a cost transference, right? Let's help you get back what you need to make you whole, but not necessarily get rich off the borrower on this transaction.
Well, that's a good thing. I want to bring that up. You said max is 3 points, and that includes points. There's also fees in there too. Like if there's an appraisal required, that would be thrown in there, wouldn't that too? Your $559.
Yes.
And then the closing costs too, right? If you're gonna have anything paid by the
some closing costs.
Yeah.
So not all. So think about closing costs in terms of what goes in your pocket. If you don't keep the profit, then it doesn't count against you. So you're the loan originator, and let's say there ends up being a title transfer fee. Well, you're not pocketing any money on the title transfer fee if the title transfer fee gets charged to the borrower in an exact amount. So that's a zero tolerance, right? And so that's one of those fees that if it comes out to $782.43, as long as you're not charging a penny more than that, that doesn't count in your points and fees because you're not profiting off your borrower. But anything in points and fees that could be construed as profit to the lender, then you're under that cap of points and fees.
Yeah.
And so that's kind of the way to look at it. Another thing that we do for you is we review all the terms of your transaction to ensure that you don't have prohibited risky features. So I'll give you some examples. Prepayment penalties are not allowed in Dodd-Frank on owner-occupied. They're viewed as predatory. Certain other points and fees are balloon payments in the first 60 months is viewed as predatory. You've got to give this individual some forecastability on when this note could come due. So if you're giving somebody an 11% loan and then you're calling it due and payable in 12 months, you're killing this family. You're setting them up for foreclosure, the very thing that the law says you're supposed to guard against. So what we do is we look at all the terms of your deal, and I flag anything that's not going to be legal, that's going to reflect poorly on your business, because I don't want your business to gain the reputation of being a charlatan or a predatory lender.
Right.
So I'm on your team to ensure that your practices pass the sniff test and that they won't draw unfavorable attention from the do-gooders at the Consumer Financial Protection Bureau. Once in a while, I get people getting crabby with me over some of that, but I always try to explain to them is, even though it looks to you like I'm raining on your parade and I'm working on the borrower's behalf, in reality, I actually work for you. I'm actually working to keep you out of an orange jumpsuit.
Well, but you're also too, you've got to you're putting your license on that document too. The ability to pay, that RMLO thing, you're holding hands with that lender in a lot of cases too, for at least, for a while.
Yeah, for sure. Now, with that said, let me say something that is extremely unclear in the industry. And so it's very important that I say this, because when people come to us as an RMLO, they construe the term RMLO to think that we are the originator on all of these notes. And in reality, unless you contract us to be the RMLO, we are not.
Right.
So an RMLO, for anybody that doesn't speak the language, is a residential mortgage loan originator. We are an RMLO, service in terms of industry type, but our standard underwrite is not a loan origination. on the paperwork that we produce for you, that your borrower will sign and take to the title company at closing and file with the county, the loan originator is you. You're hiring me to help you do it legally because you don't specialize in it and I do, but you are the loan originator. Unless you're originating in one of the 18 states that we can originate in, and we agree that we are going to originate it for you, and that's a whole different fee then. And then in that case, we do all of it. We then do the underwrite, we produce your closing disclosures, your loan disclosures, all of your federal disclosures, all of your state-specific disclosures, and we produce all of the closing docs like the note and mortgage. And we coordinate directly with the title company or the closing attorney, and we take it from handshake clear to the closing table. That's a unique service that's far more complex that we offer on a case-by-case basis in 18 states right now, trying to gain more. But so I just want to make sure that I diffuse that potential ambiguity there, that when you hire us, you are the loan originator and you're hiring us to help keep you legal.
It's good stuff. What are those 18 states?
It's easier for me to read them than it is to,
Sure.
I don't have them memorized, so I get them wrong all the time.
That's okay.
Yeah, so the 18 states where we can do full originations at this time, and this is August of 2022.
Yeah.
So again, in timestamp, if you talk to me next September, it'll inevitably be different than it is today.
Sure.
But as of August of 2022, we can do full originations in New York, New Jersey, Connecticut, Texas, Georgia, Florida, Michigan, Maryland, Pennsylvania, Louisiana, Delaware, Kentucky, California, North Carolina, South Carolina, Virginia, Alabama, and Ohio. And have 3 or 4 pending in the hopper. So that's one of those services that I like to just always do a disclaimer on and say, let's get to know each other. Send me an underwrite. Let me coach you. Let me help you. And then just bring it up in conversation later. If I wanted the full meal deal and wanted full origination, could you do it in this state? And what would that look like? And how would that benefit me? And what all would that get me that I'm not getting with the underwrite?
Right. No, that makes sense.
We'll have that discussion.
Yep. That answers Allison's question. She asked the question, do you originate in Georgia? So, yep. Very good.
Yes, we can. And so if you're wanting to originate in any of those states I just rattled off, same thing, just get a hold of me and say, we'd like to have a talk about your services. I'm in XYZ state. Can we talk? You can text me, you can email me, or you can snail mail me. And yep, we'll have a talk just like this. I do this all day, every day for folks.
Yep.
And we'll just have a one-on-one talk like this, and we'll work on the conversation will be, how can I help dive into your business model and help you in the way that you need help? Because my service is different for each person.
Yeah, no, it makes sense there for you. David asked a question here. Have you had the situation where a loan was challenged by CFPB where they said it wasn't legit?
Have not, never intend to.
Yeah.
Nope. Easy answer on that is that we don't play any games. I'm willing to be unliked if I have to. And I, as I mentioned to somebody earlier on the phone today, I did a conference with a team out of Minnesota who were looking at taking on, and I told them then, you know, there's going to be certain things that we tell you, you have to do this and this, and you can't do this and this. If you can't live with that, then we can't do business together, because we won't bend the rules. We won't fudge. I'll give you a good example. I get people all the time saying, well, we'd like to hire you to underwrite, but we want you to underwrite to our criteria, and we don't want you to break a deal over certain things. Well, then I can't issue a certification of ability to repay that ensures Dodd-Frank compliance if you're asking me to look the other way and help you make it not compliant. Can't do it. Now, I will tell you this, if there's any buddy in the crowd that is saying, well, that's a bunch of BS, I will say this. If you call me up and say, I want you to underwrite this file and I'm going to loan to this guy, whether you approve it or not, that's okay. Okay, no problem. That's just fine. And then we'll play the crapshoot game. You throw as much mud on the wall and we'll see how much of it we can make stick. You bet. You pay the 119 fee. You tell me what criteria you want me to vet this borrower from. I'll vet them for that criteria. If they make Dodd-Frank compliance, then we'll certify it and we'll do the whole thing for you. If they don't, we'll let you know they don't. We'll let you know where they're coming up short and what they have to do to remedy it. And you can rent to them for another year and help keep coaching them along, or you can walk away and loan them the money anyway and just know that you're holding a file that's not compliant in this one area. That's okay. But as for how we work, the integrity that we maintain, which allows you to feel confident and resell a note that's compliant, there's no fudging on that. And so,
yeah, that's good. I'm glad that you brought that up. Max, is definitely important. A question for you. Somebody asked on the live stream here, what do you see as the average interest rate on owner finance notes? I know it'll vary a little bit, but where are you seeing? Are you seeing stuff in tens, in the teens, and six? Where are you seeing stuff consistently?
Yes, good, excellent point. Number one, it changes daily.
Yeah.
So understand that what we're seeing right now looks way different than what we were seeing last year.
Yeah.
So everything rides on a margin, right? And so even though you guys in seller finance aren't bound to a necessary interest rate, you're still subconsciously following a margin. Everybody in the world does, right? What do you pay on the capital that you're loaning? You used to pay 2.25% on that capital. Now you're paying 5%. So maybe your spread was 6. So hey, your business model worked out good. If you were getting it at 2.25%, you're happy at 8.25%. Well, now all of a sudden you're getting it at 5. You're no longer happy at 8.25%. And so with that said, just understand that seller finance does a very, even though it's somewhat inverse, it correlates very closely to Fannie and Freddie. And so as the APOR does this, seller finance terms do this too. So right now, today, probably 9 to 10% is pretty consistent. Unless you're in a mobile home. If you're in a mobile home, I'd say 13 to 15 is pretty consistent. All of my folks that are big in mobile home businesses, they always tend to run higher. And with risk of not going too deep and confusing people, there are certain things that Dodd-Frank says, if you want an interest rate above this amount, then here's these new criteria that you have to do, and here's these new hoops you have to jump through. It's called HPML or HCM, high price mortgage loan or high cost mortgage. And for anybody writing notes, don't get too wrapped around the axle on it. It's just probably easier to have a discussion. But in general, we have to flag any loans that you're doing that end up becoming HPML or HCM. And HCM in specific, a high cost mortgage is defined as any interest rate that's 6.5% higher than the APOR, or the street rate of the day. So if the Fannie street rate of the day is 3%, then if you add another 6.5% to that, then that's now flagged as a high cost mortgage. And there are certain other conditions that we have to make sure your borrower meets to keep you out of an orange jumpsuit. That doesn't mean you can't do an HCM loan. It just means that you have to trust me when I say, I'm watching for you, and if your loan is going to be an HCM loan, then appreciate the fact that your borrowers are going to have to do this, this, and this to make sure that you're legal. And again, some people think I'm busting their chops for that, or making their life unnecessarily hard. Once in a while, I'll have people say, well, what's the most I can charge and still stay under HCM? I say, well, what day are you going to send it to me? Because tomorrow
Right.
is going to be different than today. I can't give you that number because I don't have a crystal ball.
Yeah.
In general, whatever the APOR of the day is, at whatever day we push it in here, if the APOR, and your interest rate are more than 6.5% apart, it could flag HCM.
Now, let me
If
ask you a
you're
question.
asking me-
I was
if
going to
you're
ask you
asking
something.
me to notify you, and I do a lot of custom underwriting. So if your business model is to say, hey, Max, every time we do a loan with you, let us know if it's going to be HCM and let us decide whether we want to reduce it or not, no problem. I'll do that. And that's what I do for you. That's my job. But that's just one of those things. Interest rate does have some bearing on how we work for you.
So 6.4 above the daily rates. Okay, 6.5 above is that red flag.
It
number.
triggers, it's called a risky feature. And then it triggers certain things that we have to do for you and help you ensure that your records show that you did. Exactly.
Now, Max, can you talk about the difference in interest rate and APR? Because those are two completely different things when it figures in, because that, when you're doing the close, it's different. Most people think it's the same thing. Like, it's not the same thing. So let's define that for everybody.
Yeah, absolutely. Okay. So when you and I talk, we want to talk interest rate, because that is the actual value that you get on your note from your buyer. When we add in annualized taxes and insurance and interest and servicing fee, that all gets charged annual interest as well. That ends up creating an annual percentage rate, which is always higher than an interest rate. So from your standpoint in loan creation land, just try to use the term interest rate. What interest rate will you be charging your borrower? We will help you legally disclose your APR. So an interest rate of 6.5 might mean an APR of 6.72.
Right.
Don't get lost in the weeds on that. Just try to use the terms the right way. So the legal term you want to use with your borrowers is interest rate, and that's the term we'll help you work on. And then we'll worry about legally disclosing your annual percentage rate as the law requires.
Yeah, I remember being a loan officer. That was always a thing when you get to the closing table and they say the APR. Well, I was probably 6.5. This says it is 6.5, but with all the fees you're paying an APR 6.7 or 6.8. People get bent out of shape. I'm like,
yes.
I'm like, you have to understand.
So we legally disclose that to your borrower on your behalf. The law says that your borrower has so many days of right of rescission after they sign on the line and say, yep, okay, I'm interested in a 30-year loan for $250,000 at 6.5% interest, and you shake hands. We legally disclose that, which will be the legal APR and all the things that the feds and the state tell you that you have an obligation to legally disclose to your borrower. These are the things that scare note creators. That's a service we provide. We legally disclose that for you.
Yeah, it's important because you've got to have those statements in there to be a really good piece of paper in a lot of cases.
Those are the things that get you a cease and desist order and lawsuit. Yep.
David asked a question. Texas, the taxes are so high, they basically double the payment. So wouldn't that mean the APR would be like 2 times the amount of the loan percentage? No, because the taxes aren't being paid to you, the originator. The taxes are being paid to the county.
No, that taxes in that respect, amortized over 30 years, do not contribute to an APR. No, but let's say points and fees is a good example. You're going to tack $3,000 in points and fees onto your borrower. That's going to make that APR higher than that interest rate, because interest rate is the simple daily interest on the loan amount. So if you took a $250,000 loan amount at 10% interest, and you multiply that daily interest by 365, that's going to be interest rate. But then when you take the $3,000 loan origination and you tack that to the loan amount and you amortize that over 360 months, that's going to put a fraction more interest over 30-year amortization on that guy's loan than the simple interest of 10% over 360 months will. And I know it probably sounds like gobbledygook and you guys are probably stabbing your eyeballs with forks by now because it's boring stuff. But all I can say is you just have to trust me. I mean, if somebody wants to, grab a beer with me and we'll do the Pythagorean theorem and work this stuff out, we can do that. But yeah, just all you need to know is the difference between APR and interest rate is APR takes into account every other expense your borrower is financing over the life of this loan. Interest rate is the simple interest on the amount you're loaning your borrower.
Mm-hmm. Now, if the borrower were to bring cash to the table to pay those closing costs outside, that doesn't get rolled into the APR then because they're not financing that extra amount. It's paid at closing as a part of the down payment or extra on top of the down payment.
Correct.
Right?
Yeah. The simplest thing to do is to ask us for a sample LE. That is the old good faith estimate. An LE is the loan estimate that will legally disclose the difference between the interest rate and the APR. And we can just get that for you to share with your borrower early on in the process.
Yeah. Now, from start to finish, on average, for the files, is it taking 30, 45 days, 60 days to close an owner finance deal for you, Max, or what's kind of the average amount? If you've got responsive people that,
No. I like to under promise and over deliver, but with that said, I will still say best case scenario is typically 10 to 14 business days. And realistically, we have many that we do in a week.
Sure.
So there's a lot of issues that that hinges on. Part of it is how smooth and organized and motivated you are, the lender, how much of my training you use. But one of the most important qualities you can look for in a borrower is motivation level. And I've said this on a lot of podcasts. If you have a motivated borrower, you have that kind of borrower whose attitude is, man, open the gates and let me run. You tell me what you need and I'll have it all piled up tomorrow on your doorstep. You give me a list of 50 things you want from me, I'll have them next week. That's the kind of borrower you want, rather than that kind of borrower that acts like everything is an imposition. Well, how am I going to go get that? Where would I go get that? I'm busy. It'll take me 2 weeks to go get that. Well, that's fine. But understand that that's the flavor of urgency in closing this loan is going to have. So with that said, we have some investors that pre-anticipate their loan conditions. They bring tight, clean packages to us, and they are cracking the whip on their borrower every time. We routinely do files for them that get banged out in a week and we're done. We have other investors that have a laissez-faire attitude, and it takes them 2 weeks to even get a full, complete package to us. And then when we do our work, we're missing this. And by the time we notify them we're missing that, it takes the borrower another week to get it. And then when we finally condition the loan, it takes another 2 weeks for them to get with their borrower and go chase down the documents that are needed. Needless to say, I've got loans that we put out on condition 3 months ago, and they're still orange in our file, meaning they're still waiting for 1 or 2 simple things to come back, because when we sent that condition to the lender and the borrower, we never heard back from either of them. And one thing we don't do real well is hold hands, because when we're serving thousands of customers in all 50 states, we will train you, or we'll train your transaction coordinator to hold hands. But and we still do a lot more than a bank would do.
Sure.
But if we send you back a loan condition saying, congratulations, Joe, provided your borrower will turn in a 12-month VOR, this loan can be approved. And we send that to you and the borrower. If we never hear back from you again, we may or may not have the time to go through our pipeline. And we do it. We have days when we get slow that we go back and say, let's go back through the pipeline for the last 3 months and send out a status inquiry on every single one of these as a nicety. But it's unfair to a hot to trot paying customer today that I put them off to go back and tap Joe on the shoulder that sent me one in November, and he needed one condition and he just never bothered to check his email.
Mm-hmm. Yeah, that's the truth. Now, with the originating stuff, is there, and I know it's going to vary, and we won't talk scores, but is there a down payment that you see on average? 10%, 15? I know it'll vary across the board.
You're talking LTV?
Yeah, exactly. Final LTV.
Okay.
And then also, not just besides the down payment, are you seeing people split up if it's less than a 20% down payment? You see them split up in a first and a second, or all doing just one first lien?
Yeah. No. Yeah. LTV, CLTV, and HTLV.
Yeah.
Yes, we do. What I can tell you is that we're far more diverse in seller finance than Fannie and Freddie.
Sure.
So where Fannie and Freddie, flat out, the model of the loan will dictate what the LTV has to by necessity be, right? We must at least be at a 97.5% LTV, or we will not approve the loan. In seller finance, there's no such thing. So your particular business model you might be content doing risky ones at higher interest rate that have a 100% LTV. You've got no skin in the game on your borrower, and you're content with that because it's almost a lease to own, and you're content to take the property back. I have other people who stick to 90-10. I have some people that's business model is, I like to sell partials. So what I do is I'll do we'll do a 80-20 and a 90-10, and I'll sell them both out there. And so we'll have 2 liens on every one. Anything can fly. Everything runs the gamut. In seller finance, it's really hard, even in fact, to put out a rule of thumb.
Sure.
I think the better thing to do would be, I just try to discuss it from a standpoint of saying, what is your individual risk tolerance and where are you getting your capital? Give me an example. I've got a lot of investors that ask me to help them find other investors, right? They'll say, hey, listen, they send me flyers all the time and say, I've got a partial for $23,000 that's going to pay 9%. Can you find me an investor for that? And I'll go out and look for it. And so then, that's going to be a situation of whoever borrows that money or loans that money to them, they're going to have to be comfortable with what that risk is. Other people have a different mechanism for generating their capital. And so maybe they're self-funded entirely, and in their group, they're content with taking the thing back. And so being at 100% LTV is fine for them.
Right. That makes sense. Everybody's business model is a little bit different. I'm always a big proponent of, getting at least 10% down payment, especially if you don't want to take that property, because the more skin in the game you get from the front end, as long as it falls in line, it's less likely to default. Yes. But then if you're not at a 20% down payment, doing a first and a second at the same interest rate, so it's the same payment if they did one, but having an 80% first is much more attractive if they look to refinance in 24 months. If they've worked on their credit, they've worked on that stuff. When 80% first is better to get refinanced. If you versus a 90%, an 80-10, well, you get the 80% refinance and you hold the 10% second for cash flow without taking that in a discount in a lot of cases.
Yep, exactly. And I mean, there's literally nothing you can propose that I haven't seen.
I'm sure.
So, I mean, when we talk creative finance, we're talking creative wraps, partials, seconds, balloons, arms, you name it. Yep.
That's what I was going to. I'm glad you brought that. Are you seeing people do more arms these days, or originating arm loans? Yeah,
we are. Bear in mind, again, there's some specifics that have to be observed in Dodd-Frank for owner occupied with respect to arms.
Right.
And so, and it can be too complex to just rattle out for the purposes of this presentation. But if you have some good reason why an ARM makes good sense in your business model, and you want to talk about the feasibility of incorporating an ARM, give me a call and we'll talk about it for sure, because we do them. Yep, we do them.
Got a question from somebody on the YouTube live stream here asking, what if somebody's financing buying in an LLC? Dodd-Frank is out the window. You still need to qualify, or how does that work?
Yep. If they want to buy it through their entity, the question always goes back again, can it make somebody homeless? So is it still owner occupied? If it's owner occupied, they do not get around Dodd-Frank or ATR. You bet we'll if you want to buy a trailer house in your LLC's name, but you and your family are going to live in it, we can put it in your LLC name when we're all done. But this still has to meet all the same elements, because if you fail to pay and they have to take it back, that's still another family on the street. Now, with that said, let me say this. I do a lot of underwriting for investors, non-owner occupied.
Sure.
And so if any of you are in the process of buying properties, rental properties, or your customers are buying rentals from you, I can still underwrite all those, and I can still give you a really good risk analysis and all that. And then I will underwrite those to your specific criteria, because if it's non-owner occupied, then you can say, hey, I'm content with their DTI being this amount, and I just want to see that they have, so much reserves in the bank, and that they've got X disposable income every month. You tell me what to underwrite it to, and that's what we'll underwrite it to. But if it's an owner occupied deal, the law tells us how to underwrite that.
Mm-hmm. Well, I just wanted to bring it up. Somebody had asked that question earlier about it, and I'm like, you still got to go through some things, making sure the person can still sell it. Now, somebody asked a question: if somebody's got rental property and they're looking for owner financing, maybe they took over a property subject to, and they've got a wrap from somebody else. Does rental income, property income, figure into their ability to pay? I know that when we were originating, the most we could take would be 65% of the monthly rents to figure out there. Is there a number that
75?
75 okay.
Is what we figure. You nick 25 for taxes, interest, insurance, and overhead. So, and so what that would look like, and we deal with a lot of it. I mean, I get a lot of borrowers that come to us that already own 16 rentals, and now they're wanting to buy another rental. And so one of my investors is going to loan them money and wants them underwritten. No problem. So, then we'll look at rent rolls. We'll look at executed lease agreements, and we'll crunch the numbers. And roughly, if they're gross on $1,000 a month in rent, most of the time they're going to get around 750 in GMI off of that.
That's awesome. This is good stuff there. Max, you have been a wealth of information today on NoteCamp. And for anybody that's out there, hopefully you see the value in having Max on your team, or using Max to help you out. If you're dealing with an issue, is it okay if folks call you to pick your brain or ask a couple of questions? That's why you have the name. Call the underwriter.com, right?
Underwriter, yep. We do it all the time. So, and 90% of the time, I mean, you'll be talking to me. So it's not one of those kind of companies where, you're going to have to try to work for a week to get a hold of anybody that has an actual answer. You're calling my literal phone that I carry in my pocket, and unless I'm outside on the tractor, you're going to get me, and we're going to talk, and we're going to talk about what matters to you.
Okay, so I got to ask, what kind of tractor?
A Kubota, of course.
Kubota, there we go. Well, hey, you never know.
And I can now tell you, I'm thinking about starting another business now as a tractor rollover tester, because I did that now this year and got launched. And I can tell you that you can survive a Kubota rollover with a cup of coffee in your hand if you do it just right. But I highly unadvise it.
Yeah, definitely. Another question here: is there a minimum loan or a low level amount that you won't go below to owner finance?
Nope, because unlike a bank that's doing everything for profit, we're charging you a flat fee. So nope, I've done $8,000 loans.
Oh wow! So, what was that on?
I think it was just a bridge. So it was somebody that was going to have a 90-10 split, and they didn't even have the down. And so investor was going to even carry the down for him for, I believe it was maybe only 6 or 8 months.
Okay. Wow. That's
So
interesting.
you name it, I've seen it.
I'm
Yep.
sure you have. I'm sure you have. How many total files have you looked at? You ever keep up with that? How many you get? I know it's probably thousands and thousands and
Hey,
thousands.
Scott, I've had days where I look at the same file 75 times. So, but yeah, you're going to catch me on a bad beer day if we go there.
I would say that
But
too.
yeah, yeah.
That's why you pulled their hair out in those days. Yeah.
Put it this way, I've looked at as many files as I treated puking patients with diarrhea over 30 years as a firefighter.
That's a lot. That's definitely
That's
a lot there,
of
buddy.
files. Yeah.
It is. Well, Max, thank you so much for coming on. Best way, call theunderwriter.com there, guys. Go to the website, check it out, follow them on LinkedIn, connect with them on there. You got a great resource there for it if that's a strategy you're looking to do. And Max, you and I, we know we're going to have another phone call or two after this on some of the other things we talked about beforehand. But
for sure,
looking forward to having you on again and continuing the relationship for you. So
sure. Let me just say real quick too, I'm always open to affiliate link situations and referrals. And so if you refer people to me, I'm willing to work with you on that. I'm also willing to refer people to you if for my folks in various states. For instance, right now, any of your listeners that are looking to loan money in South Carolina, I have a $300,000 deal that we're looking for somebody to loan money on an owner-occupied house in South Carolina. Get a hold of me if you want to loan money or somebody that does. Those are all things I just typically do for free just to support the network. If you're looking to buy notes, I can put you in touch with note sellers. If you're looking to sell notes, I can put you in touch with loan buyers, note buyers, and I can help you build notes that are specific with the intent to sell them.
that's perfect.
Yeah, so we do a lot of networking all the way around.
That's awesome. That's the whole point of this is building a network and helping you take your business to a whole different level. So Max, thank you again so much for coming on here. We look forward to talking to you some more later on. All right, buddy.
Sounds good, Scott. Thank you very much.
Thank you.
Take care.